What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome back to another episode of the CPA Zone. I'm your host, Ryan Pulis, and today we're going to talk about short-term rentals again. So basically, we want to talk about, short-term rentals and is it the right move for you, and just make sure you're aware of all the potential traps out there. Getting a lot of questions lately on short-term rentals. So I know we've covered it before in the past, but I thought it'd be good to go back, review, and just hit it again. So let's dive in. So first and foremost, short-term rentals are not just easy money, not just a simple tax write-off. I get it. It sounds like it could be easy money. Seems like a very simple tax strategy, especially if you read some stuff online, which is often very incomplete at best. Maybe you have an extra room in your house you're thinking about renting out, or great vacation property. You just throw it on Airbnb, you make a bunch of money, and get a huge tax write-off, right? Unfortunately, it's just not how it works. And I know with 100% bonus depreciation coming back now, there's even extra incentive and a lot more people talking about and pushing this strategy. And totally legit strategy just needs to be done right. But very important to remember, it's real work. And if you already self-manage short-term rentals, what I'm about to say is no surprise. A lot of work, not passive. If you run your own short-term rental properties and you run your short-term rental business and you want it to be profitable, it's not sit back and just collect rent. And a lot of people start down the short-term rental path, thinking it's they're going to get a great tax write-off and put in minimal time. Airbnb will do all the work. And first off, I should say, don't let the tax tail wag the dog. Make sure you're prepared to put in the time to make a property profitable. Whatever you do, don't buy an underperforming asset just for the tax write-off. You want to make sure it's going to perform and actually make you money. The tax write-off's great, but it's a year one thing. After that, you still own the properties. Make sure you're going to make some money on it. So, and one thing to look at, is this a rental or an active business? Because the IRS puts short-term rentals in this a bit of a gray area, if you will. So under the passive activity loss rules, if you rent a property for less than 7 days at a time, the IRS considers it a business. It's not a rental. So that means you can deduct your losses as long as you materially participate. So too often that material participation piece is what gets missed. You still have to materially participate. Generally, most people are doing that by either doing everything themselves or proving they spend at least 100 hours and more than anyone else working on the property during the year. So the short-term rental loophole is tailored around this rule. Investors will buy a short-term rental. They have a cost segregation study done to accelerate depreciation, and they use that year one write-off against active income. The following years, you can convert it to pass, maybe hire a property manager, but you still have the property and you still need it to make money. You want this asset to be in your portfolio and do well for you. It's not just a tax play. Another big area where we see people really kind of shoot themselves in the foot is with personal use. If you are using the short-term rental loophole, don't have any personal use, at least in that year. Future years, when you're a little more hands-off, if it's a bit more passive, you want to use it here and there, that's fine. Your expenses get prorated between business and personal. However, when the property is used 14 days, the greater of 14 days or 10% of the rental days in any given year, it then becomes a residence. You cannot deduct any losses, even if you materially participate. You've just changed the classification of the property to a residence by doing that. And just know, use by family members is considered personal use. So be careful letting your family use it. Even if they pay you rent, if it's not their primary residence, it's considered personal use. Now, another area that trips up a lot of people is the state and local surprises that come up. So many cities require you to register as a business if you're doing short-term rentals. You might owe hotel and occupancy taxes, which are basically a sales tax for short-term rentals. Even if you're just renting it out to a few weekends a year, these vary greatly by locate or by area. Some counties are pretty simple and easy to work with. Others are very difficult. Some don't even let you use short-term rentals in their area. So make sure you take care of all this stuff and pay attention up front. Do your research early and figure it out. Make sure you're dotting all your I's, crossing all your T's, and not doing anything that's going to get you in trouble. So you want to check your city or county's short-term rental regulations. A lot of places have been cracking down on this. Now, one last thing before we go, just a brief story kind of touching on that personal use. We reviewed a tax return for a potential client who rented out a vacation condo on Airbnb. I think they rented out for like 80 nights. He handled all the bookings, cleanings, did everything, had the material participation down, great material participation log, had everything really buttoned up. He was selected for an audit, and the IRS denied the losses from the property because he and his family members had more personal use to put them over that limit, and it ended up costing him about $35,000 in additional taxes. He just was not aware of that rule, didn't track the personal use time. He had asked us to take a look at things after he got the determination letter, and unfortunately the IRS was right, and he was kind of stuck with it. Just didn't miss that one piece, and that really cost him big. So make sure you're paying attention to these things. Make sure you're keeping good records of everything. But short-term rental loophole is great. We work with a bunch of people that use it. Really great tax strategy. However, it does need to be done right. And if it's not, it can catch up to you and backfire. But that about does it for today. I hope you found value in this episode. If you did, please hit that like and subscribe button. And until next time, have a great day. Are you interested in becoming a client? Click the discovery meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.